Konnichiwa. Ramadan Mubarak. In this week's edition we'll talk about corporate news in the UAE and also DP World's profit result released today. In corporate news this week, government-owned Dubai Holdings has announced that it will merge its three existing property companies, Tatweer, Dubai Properties and Summer Dubai, ahead of the pending consolidation with Emaar Properties. The combined company will have one of the largest land banks around the Middle East. We retain a neutral stance on Emaar at present time, given that the details regarding the consolidation with Dubai Holdings are yet to be announced. The second quarter profit pre-abnormals actually increased on the first quarter. Emaar has a large property portfolio around the UAE and also the GCC regions, including the large Economic Gate project in Saudi Arabia, which we believe as a combined portfolio will continue to generate income and earning streams for Emaar over the coming 6 months. Emaar currently trades on a 08 PE of 5.9 times and a price to book ratio of 0.5 times, meaning that a lot of the potential downside to its earnings profile is factored in to the current share price. Foreign investors were net buyers on the DFM exchange last week, accounting for around 46% of total buying, well above the 38 to 40% average we've seen for the rest of 2009. Air Arabia has announced a new flight route this week to Medina in Saudi Arabia, part of the low-cost carrier's push into the Saudi Arabian market. Air Arabia now has 58 destinations worldwide that it is actively flying to. Market reports that UAE insurance companies are likely to be forced to bolster their underwriting activities to offset investment losses during the second half, highlights the risk involved with the UAE insurance sector at the moment. Our preferred play, considering its more favourable risk profile and high growth profile, is GCICO. The value of ongoing industrial projects in the UAE has fallen to $175 billion US, a drop of 17% year on year. Falls were recorded across utility, infrastructure, oil and district cooling sectors, partially offset by an increase in the number of gas projects around the UAE. Construction company Arabtech has been awarded the 687 million dirham Onyx Towers project in Emaar Business Park, Dubai. The project will commence in September of this year and we estimate will add 4% to earnings per share for 2010 and 3.5% to EPS for 2011. The project announcement is an important step in giving us confidence that project life is still there in the Dubai property market. According to the UAE Central Bank, bank loans and advances declined very slightly by 0.2% during July to over 1 trillion dirhams. This is part of an ongoing phenomenon where we've seen the gap between loans and deposits decreasing towards 104%. Saudi-based Al Ghassabi Group has stated that it will sue Dubai-based Mashreq Bank due to the lender being willfully blind to irregular deals that took place with Al Ghassabi, leading it to default. The ongoing dispute with Al Ghassabi and Saad has created a constraint over valuations of banking stocks in the Saudi region and to a lesser extent in the UAE region as the two Saudi groups reorganise $22 billion worth of debt. Volumes in the market have been a lot lower this week with the first week of Ramadan. However, we believe that next week we'll see a raft of fresh money as local investors begin to increase their trading activity and liquidity on these markets. With PEs so low, we still see good accumulation value in some of our preferred stocks, including Air Arabia, Gulf Navigation, Etisalat, Do and a number of others. That's all for corporate news this week. Dubai Ports World, listed on the Nasdaq Dubai, has issued first half 09 profit this week. Looking at the numbers, revenue of just under $1.4 billion was down 13% year on year, and net profit of $188 million was down 34% year on year. Overall, the result was well above our expectations, and we've seen the stock price rally over the last week in anticipation of the good result. The better than expected profit result was driven by around 15% of fixed costs being stripped out of the business, and a transition from a greater proportion of fixed costs to a greater proportion of variable costs, leading to an expansion in profit margins above our expectations. DP World continues to increase its investment in its terminal capacity, with terminals at Jebel Ali and Djibouti and also Vietnam and India increased during the first half. Capital expenditure was over $500 million, which was funded largely through debt. However, interest coverage remains in a solid position around 4 times EBITDA over interest, and also net gearing over equity is around 60%. The all-important Middle East region contributed a solid result to profit, with net profit down 19% to $284 million, including the contribution from the new terminals. Importantly, the company really managed to improve its cost position in the Middle East, with margins improving as a result. In the Asia Pacific region, revenue only declined by 7% to $249 million, and net profit was steady at $90 million, driven by a particularly strong performance from the ports in Karachi and also the terminal expansions in Vietnam and India. However, in the Australian and American region, revenue lagged significantly, falling by 30%, which was doubly hit at the profit line by currency losses as well as a squeeze on profit margins. Net profit declined by 77% in this region to $16 million US. On our initial numbers, the profit result being above expectation has led us to increase our forecast for FY09 profit by around 8%. Overall, however, we retain our valuation at 48 cents per share, and overweight recommendation at last close of 40 cents per share. We believe that DP World offers excellent exposure for investors to world trade volumes, particularly volumes in emerging markets. The Baltic Dry Index is down during the second half. However, we believe that with world growth forecast trending positive for 2010, this bodes very well for emerging market trade, which will flow through to DP World's containerisation volumes and improve profitability, particularly considering the company has been able to strip so many costs out of its business. So that's all for this week. Ilarika and sayonara!